All right, today we're going to tackle a topic that often feels like a total black box in a company's financial statements: income tax. We are going to pull back the curtain on the accounting standard IAS 12. This is the key, really, to understanding how a company reports its tax expense. And trust me, the answer is probably not what you think. So let's just jump right into the central puzzle here. You see a company report $1 billion in profit, right? So you'd think, okay, I'll just multiply that by the corporate tax rate, and boom, that's their tax bill. Seems logical. But it almost never works that way. The reality is way more complicated, and the reason for all that complexity is found in this rulebook, IAS 12. And here's the absolute core of the issue. Companies are essentially running two different sets of books. Now, that sounds shady, but it's totally legal and, frankly, necessary. One set of books follows accounting rules to come up with what we call accounting profit. That's the number they show investors to say, here's how well our business is doing. The other set uses the government's tax laws to calculate taxable profit, and that's the number they show the tax authorities to figure out what they actually owe. The key takeaway? These two numbers are almost never the same. So, here's our roadmap. We're going to start with this two profits problem. Then we'll look at how something called temporary differences act as a bridge. That'll lead us right into deferred tax liabilities and assets, and then we'll wrap it all up with why any of this actually matters to you. Okay, first up, the two profits problem. This is all about getting to grips with that fundamental mismatch we just talked about. So, on one side of the ring, we have accounting profit. This is the big pre-tax number. Its whole purpose is to give investors a clear view of a company's raw performance. And on the other side, you've got taxable profit. This one's calculated completely differently, using the government's specific tax laws. It's the only number the taxman cares about when it's time to send the bill. So if we've got these two different worlds, how in the world do we connect them? Well, that brings us to the absolute heart of IAS 12, a concept called temporary differences. Think of this as the magic ingredient, the matchmaker that reconciles what investors are seeing with what the tax office is seeing. Now, don't let the jargon scare you. At its core, a temporary difference is just the gap between what an asset is worth on the company's own books, that's its carrying amount, and what the tax office says it's worth, that's its tax base. This simple gap, this difference in opinion, is the source of all the complexity we're about to unpack. The logic flows kind of like this. It all starts when one item, let's say a piece of machinery, is treated differently for accounting than it is for tax. Step 2, this difference creates that temporary difference we just mentioned. Now, here's the crucial part. It's called temporary for a reason. Eventually, that difference will reverse itself and go to zero. So the entire point of IAS 12, the whole game, is to make companies account for the future tax impact of that reversal. Right now, today. Okay, so this process leads us to our first major outcome, something called a deferred tax liability. This is what happens when you know you're going to have to pay more tax down the road. So what is it officially? Well, a deferred tax liability is basically income tax that a company knows it will have to pay in the future. It's not a bill that's sitting on the desk today, but because of something that's already happened, they know for sure that bill is coming. You know, the easiest way to think about it is like this. You got a tax break now. The tax rules let you pay a little less today than you might have expected. But it's not a free lunch. IAS 12 forces you to put a liability on your books, basically saying, yeah, we got a benefit today, but we know we have to settle up with the tax office for it later. Let's put some actual numbers to this to make it real. This is a classic example. Imagine a company has a machine, and on their books, its value, the carrying amount, is 100. But the tax office let them use accelerated depreciation. So for tax purposes, its value, the tax base, is only 60. See that gap? That creates a taxable temporary difference of 40. Now, the company has to recognize that in the future, 40 of income generated by that machine will be taxed without any more deductions. So you take that 40, multiply it by the tax rate, let's say 25%, and you get a future tax bill of 10. That 10 gets booked today as a deferred tax liability. All right, now let's flip that coin and look at the other side. Deferred tax assets. This is what happens when the temporary difference means you'll actually pay less tax in the future. The official definition calls this income taxes that are recoverable in the future. What that really means is the company has paid more tax now than its accounting profit would suggest, but it gets to recover that overpayment later in the form of a tax deduction. Put simply, a deferred tax asset is kind of like prepaying your taxes. The tax rules might make you wait to take a deduction for an expense, even though your accounting rules say you've already incurred it. So you end up paying more tax today, but you get to put an asset on your balance sheet that represents that future tax break you've earned. Okay, here's the classic example for this one. A company expects it's going to have to pay out $100 in the future for product warranty claims. For accounting, that's a real liability and they book it right away. But the tax office says, nope, you can't deduct that expense until you actually cut the checks and pay the claims. So the tax base for that liability is zero. That creates a deductible temporary difference of $100. When the company finally pays those claims, it'll get its $100 tax deduction. At a 25% tax rate, that future tax saving is worth $25, and they recognize that today as a deferred tax asset. So, after all of that, the debits, the credits, the liabilities, the assets, we land here. Why? Why does any of this accounting wizardry actually matter? Well, this is the big picture, the reason we do all this work. You know, the best answer comes from the standard itself. Its main goal is to account for both the current and the future tax consequences of everything a company does. If we didn't have deferred tax, you'd only see half the story, what the company is paying this year. You'd have no warning about massive tax bills or huge tax breaks that are waiting just around the corner. So ultimately, IAS 12 gives us a much more complete, more honest financial picture. It forces companies to be upfront about future tax bills and future tax breaks, and that makes it way easier to compare the true financial health of different companies, so you're actually comparing apples to apples. And at the end of the day, these deferred tax items directly hit a company's balance sheet and the bottom line net income it reports to the entire world. And that brings us to one final thought to leave you with. We've established that this whole thing, deferred tax, is really just about timing differences. But that raises a really fascinating question. What happens if the rules of the game change halfway through? What if a government decides to change the corporate tax rate before a company's temporary difference has a chance to reverse? Well, that's where the true complexity and the real importance of this accounting standard truly shines.